Hey, Assalamu alaikum wa rahmatullah. Greetings of peace. This is Rehan. Just wanted to share some thoughts with you. And so it's Friday the 19th of May. And, you know, there's a looming, debt crisis, so to speak. The markets are hollowing out. There's great dispersion in the S&P 500, meaning, there's only a few, big companies holding up the index, and um, everything below that has been falling. So it hasn't been performing like the top constituents. So you see a hollowing out of equities, which is definitely a bearish signal. And then we have this brinkmanship that's happening in the United States with regards to moving the debt ceiling, and the political parties, basically the Republicans, using it as a bargaining chip, because obviously the impact of the U.S. government defaulting or not being able to make payments is so catastrophic that, of course, it would force both sides to the table. And unfortunately, it's been happening for so many years. 78 times, I believe, is the number that the debt ceiling has been raised. So, obviously the consensus and base case is that they will raise the debt ceiling again. They're just trying to figure out by how much, and how much of a deficit is, liked, or an appropriate compromise between the two political parties in the state. So that's going on. China's reopening has been a big nothing burger, so to speak. There is basically no reopening in that sense, no real demand that was supposed to save the global economic system. The yuan is falling at the moment, and there is remarkable uncertainty in the markets as we lead up into June. And obviously the 1st of June is when they need to make a decision on the debt ceiling in the United States. What I find interesting at this point in time is one thing we need to note is that U.S. debt is at an all-time high. But this is also a phenomena throughout the developed world. Global debt is at an all-time high, in the sense that in the history of the world, we have the most amount of debt that we've ever had in known history. So that's obviously an interesting fact to have. Now, in this climate, the U.S. has around $30 trillion of debt, and that's the ceiling. And they have just, over the past 12 months, hiked interest rates by 500 basis points, which is the fastest known interest rate hiking cycle in the past 30 years. And they're doing that because they say they're fighting inflation. And that's an interesting argument. Obviously, modern day Keynesian economic argument that they're making. It is the conventional wisdom of the day. But there are obviously many countries, or a few notable countries, who have experienced hyperinflation in recent times. You got Venezuela, Zimbabwe, Sri Lanka. There's like a few noteworthy countries, and their interest rates are astronomical, but it hasn't really curbed their inflation. So they're up there in the 60, 70, 80, 100%. And so that relationship that people think is, or they take it as dogmatically true, is not empirically evidenced. It doesn't always work, right? So it's not hard science. It's theoretical, and human beings and our economies are complex things. But one thing to note, raising interest rates to fight inflation when debt is very, very high, or reasonably high, results in some really bad side effects, as in for the purpose of trying to fight inflation. So one side effect of raising interest rates to 5%, for example, when you have government debt of $31 trillion or so, is that the government now starts paying significantly more interest payments on that debt. And that debt is held by the private sector, right? So you're fiscally spending more and putting that directly into the pockets of the private sector that holds your debt, right? It could be the general public, it could be insurance companies, it could be um, uh, obviously people who hold treasuries, it could be hedge funds, it could be pension funds, it could be a whole bunch of local and international recipients of that debt payment. So now because the Fed has raised interest rates so rapidly, the Treasury now has to start making more interest payments because it flows through to the Treasury's debt that they're issuing. So we're seeing that the U.S. government now, while they're trying to fight inflation, are actually starting to pay a lot more interest, which kind of undoes some of the fight, because you're basically fiscally stimulating by increasing the amount of payments that the government's making and spending to the general public. And so you're stimulating while you're trying to reduce the money supply. And the way they try and reduce the money supply is by increasing interest rates, and that makes it harder for people to borrow, right? And borrowing is how the money supply expands, right? That's the way that modern banking and the economic system works. And so through this conventional means of increasing the money supply, which is through debt, they can try and reel it in by making it harder to borrow. Therefore, less money is lent. Therefore, there's less supply of money to the masses. Now, in a high inflation environment where you have a lot of debt, one, obviously you're fiscally stimulating because you're paying out more, and the people who are receiving that stimulus, because they have a lot of capital, clearly which they're not really spending, are incentivized to seek higher yield. And so they can go, instead of just parking in treasuries and getting, let's say, 5%, they can go into corporate debt or other forms of debt where they could get 7-8%. They could get higher yield, right? And so you have this fascinating kind of, and of course they're earning more, so they can lend more. So you have this, as the yields go up, as interest rates go up, there is a greater incentive for the creditors to lend more, obviously because they're getting more yield, right? And the only way they can access that yield is if they actually actively lend into the market. So you create this side effect where you're incentivizing lending from the people who have the money, right? So they want to lend more because they can get more yield. Okay. On the borrowing side, the demand side, inflation is already doing the job of creating demand for credit because people don't have enough money, right? All of their expenses have gone up, some twofold, depending on the items that they're involved with, that they buy. And so as these expenses have gone up, people have less money, they need more money. And so that inflation creates a demand for credit, right? So that's because people don't have enough money. And so you have the demand for credit rise because of inflation, and you're trying to fight that by raising interest rates. The supply of credit increase because people are getting paid more interest, therefore they have more to lend. And so the private sector lending has an incentive to lend out more, and even banks have an incentive to lend out more because they can make more money on the spread. So for the same amount of capital, you can make more money as interest rates rise. So we're in this interesting situation which the Fed has created, where fiscal spending has to go up to meet the interest rate demand, right? As in the imposed interest rate that the Fed has put onto the market, and then increased demand for credit, which is already there because of inflation, and increased supply of credit because the rate of return on credit has gone up significantly. And so you've got this like really split brain scenario where the Fed, through its action of increasing interest rates trying to fight inflation is creating stimulative effect for money supply expansion at the same time. So they're undoing their own work, right? Now, when total debt of the government is small, right? It's a small portion um, of GDP. It's a small percentage of assets in the economy. Then that increase in interest payments is less significant, right? Um, Whereas in this case, where the U.S. government's at what 120% GDP, with regards to their debt, that means that the increase in interest rates has a sizable impact on the fiscal stimulus that is produced through the interest payments, right? And so we have this problem of the velocity of money increasing because the government's making more interest payments out there. So it's, in a way, I think the Fed's policy is a huge mistake currently. But as you say, or as they say, for a man with a hammer, everything looks like a nail. And so the Fed is deciding to use interest rates, which is their preferred policy tool, to fight inflation, and unfortunately undoing some of that battle themselves, right? So there is a great risk that this inflation will prolong because they've created incentives for lenders to lend more, and inflation itself is creating incentives for borrowers to borrow more. Now, if you wanted to fight inflation, the reality of inflation is that it is self-regulating. So inflation is mean reverting because it creates in and of itself a shortage of money, right? So as inflation rises, things get more expensive, and if all else remains equal, people have less money to spend, they curb back on their spending, and prices self-regulate. So it's not sustainable. Inflation is not sustainable if all else remains equal. It self-regulates people's behavior, and when people need more money in the absence of lending, they have to go out and seek more work, meaning they have to increase the supply of goods and services. And so when you increase the supply of goods and services because you have scarcity of money, then that also brings down price levels, right? Because if demand is constant, supply is increased, and there you go, right? So you've got another mechanism for inflation to self-regulate because it directs people towards certain behavior. So that's great. So if all else being equal, inflation can self-regulate if you give it time. And I think that the Fed, understanding that inflation is transitory, was correct. However, they didn't know how much time it would take, and people are impatient, and it was a political misstep because inflation makes a lot of people unhappy, right? So people don't like inflation because it affects everyone, and so they whinge about it, and so politically, it's people. Unfortunately, people would prefer, those who keep their jobs, that is, that unemployment rises over experiencing inflation, because at the end of the day, when unemployment rises to 10%, it's still 90% of people, right, who are voting, who didn't necessarily suffer. Whereas when inflation rises, it's 100% of everyone who's suffering, right? So politically, unfortunately, the way that human beings seem to respond in a political sense is they whinge a lot more about, as a whole, about inflation rising as they do about, oh, the unemployment rate went up from 5 to 10%, for example, right? Even though for those 5% of people who are now out of jobs or homeless or no longer part of the productive economy, maybe they've turned to crime, whatever they've done to try and survive, that is absolutely devastating, right? But, Keynesian economic theory all works in aggregates, unfortunately. And so, fighting inflation becomes a political thing. And so the Fed, because its reputation was tarnished and everyone was blaming them, then said, well, all right, we'll solve this. And how do they solve it? Well, it's just you take a page out of the textbook. You don't need to think about the decision. This is a default conventional economic theory, right? Inflation is high, you just raise interest rates without them really considering how much debt they have, how that also has a fiscally stimulative effect. And the reality is, one thing that I do believe they know is that even if they did nothing and government fiscal spending just went back to pre-COVID levels, inflation would go away. But Fed Chairman Powell has a legacy to uphold. So he's going to be a hero. This is his chance to be a hero. And so he jacked up interest rates, which is their preferred policy tool. They needed to reload their weapon because at zero you can't do much. You have to do these funny things like QE and so on. So they needed to reload their interest rate weapon. And so they used this opportunity to do so, and they chose extremely lagging indicators so that it would give them time to raise interest rates to a significant degree so they can reload their weapon and regain power, right? This is a central bank that had lost power, had lost control, and in their hubris, they need to regain that. They need to feel like they're back in power, they're back in control, right? So they need to recharge their weapon. And so for them to, refill their magazine, they need to raise interest rates. And so I think the inflation fight was obviously an excuse, the perfect excuse, never let a good crisis go to waste, for them to reload that weapon, to jack up interest rates to a point where now they feel like they're back in control, so that if they need to stimulate the economy because they feel like it's their responsibility somehow, that they can artificially do so through manipulating interest rates, dropping them when they need to, raising them when they need to. So there is, and I'm being extremely critical of people, but at the end of that, people are people, and they are motivated by ego and legacy and so on. So now we have the world's most important central bank, their chairman being a hero, right? And when inflation comes down, because it will, it has to. It's a self-regulating phenomena. All you need is government spending to go back to where it was pre-stimulus, and things will reset. And so that's what we're waiting to happen. In the meantime, the central bank has used it as an opportunity to recharge their weapon and take credit for bringing inflation down, which would have come down anyway. So in a way, the man's a hero because inflation went down, and he will take credit for it, even though much of what he's done has slowed down the effect, or slowed down the rate at which inflation will fall, right? But he can pat himself on the back and say, look, I did it. I'm a hero. People will write books about him. He'll have, I'm sure, his own publications, and he'll retire. And he's a wealthy man, right? So his net worth is, maybe, way into the maybe $100 million, right? So he doesn't need the money. But for a person who doesn't need money, fame and power is really their drug. And so I think inflation will come down eventually if they don't keep slowing it down by fiscally stimulating, and he will get the credit for it, and he'll be a big hero, and there'll be a whole world of pain as we go into this oncoming recession. So the conference board that has leading economic indicators for recessions, their LEI is now flashing red for a recession. So it's a clear signal that a recession is pretty much guaranteed if we continue down this course. So there you go. We're going to get our recession. A whole bunch of people are going to lose their jobs. Warren Buffett's already mentioned that they're expecting revenues and earnings to be down this year in their portfolio of companies. He's just being honest. And so we're going to see that kind of economic crunch happen. We've already mentioned the dispersion in the S&P 500, which is also another bearish signal, meaning it's hollowing out of the index. There's only a few names holding it up, while everything else is going bearish. And obviously we've got this debt ceiling, brinkmanship that's going on as well, which is not healthy for the U.S. economy. And the other thing that's going to happen is as soon as they resolve the debt ceiling issue, the Treasury is going to refill its account at the Fed, right? And it's getting dangerously low right now. So they're going to soon run out of money in that account to make government payments. But they're going to refill that to maybe $600 billion as soon as that debt ceiling is lifted. And what does that mean? That means a whole bunch of money gets taken out of the economy because people buy this debt. Someone has to buy it. So people are going to buy that $600 billion worth of debt, and that's money that goes into the Treasury's account at the Fed, right? So that's a liquidity negative event. So there's money that's going to be taken out of the system in one big move when they refill that account by issuing debt. So, come June, the liquidity situation will get worse, which means it'll be harder for people to find dollars, right? Because they're sitting in the Treasury's account at that point in time, and then they'll spend it, over time. So in the short term, things are looking kind of bearish, or very much so, and we'll keep watching the markets. We're watching as um, different asset classes go bullish or bearish. Right now, there's a lot of bearish, well, across the board, a lot of bearish activity. Even gold has just kind of dropped a little, so it's correcting a little. So we're seeing gold also turn neutral or bearish at this point in time, but I don't think that's a long term. That's not a long term view of mine. But in the short term, if you're worried about short term volatility in gold, you might want to hop out and then. I mean, it's not financial advice, but that's what I'm looking to do is hop out of gold and gold miners, and then see when things turn bullish again. But it's all tactical in this environment because things are moving so fast and there's so much volatility. Not many trends are persisting. Oil is falling as well. There's a whole lot of inflationary forces. So, it's only a matter of time when this recession, officially arrives. But the leading economic indicators have confirmed that it will happen. Whether it's Q4 or Q1 of next year, um, you know, that remains to be seen. But we're definitely headed in that direction. Anyway, those are some thoughts that I wanted to share with you guys. If you have any comments, rebuttals, anything that you'd like to share on this, provide any feedback, please reach out to me, and would be happy to field your questions, all right, and hear your opinions as well. All right, thank you very much. Salams, greetings and peace to you from Rehan and from the team here at Halal Stocks.